9.9 Stocks and bonds as options. Until this point, we have discussed how publicly traded options are defined and valued because much trading happens in these listed options. Nonetheless, many corporate policies can be deemed as options. Here we will show that there are examples of implicit options. First, stocks and bonds as options, capital structure decisions as options, and lastly, capital budgeting decisions as options. Let us see how stocks and bonds can be considered options. The example will follow. You found a new toy company called Banzai that would produce and market state-of-the-art action figures with high articulation. Luckily, you won a contract through which Banzai was trusted the license to produce and market toys for the video game The Legend of Sarah. Banzai could sell these toys for a single year, that is the next year, after which Banzai will cease operations and be disbanded. Banzai has issued debt to help finance this venture. Interest and principal due on the debt next year will be $450 million, at which time the debt will be paid off in full. Banzai's cash flows next year are forecast as follows. So Banzai's cash flow schedule, there are four equal likely scenarios. One will be the first one, amazing success with the toy line, and then moderate success, moderately disappointing sales, and outright failure. So we have cash flow before interest and principal for each of these scenarios. And of course, the interest and principal to be paid to debt holders for the company is also being shared here. 450 million if actually uh, the two first scenarios actually happen, amazing success with the toy line or the moderate success, and if not, this will be the cash flow schedule. And then of course cash flow to stockholders will be the difference between cash flow before interest and principal and the interest and principal to be paid to debt holders or bond holders. So each scenario is equally likely to occur again. So plot the payoff table for both the bondholders and stockholders and assess the position of both parties in terms of options. Who are the option holders and writers, and what kind of an option do they possess or have they written or sold? Again, by just looking at the cash flow schedule, you will see that for the first two scenarios, actually, they the bond holders will be paid in full at $450 million, and the remaining amount between the cash flows, the total cash flows to the firm, and the interest and principal to be paid to bondholders will be cash flow to stockholders, the difference between these two values. But of course, if the cash flows to the firm actually is less than what the firm owes to the bondholders, actually, uh, bondholders will receive everything that was produced by the firm in terms of cash flows, and actually stockholders will receive nothing in that case. And this is the case in which the cash flows are less than $450 million, which is the amount to be paid to bondholders. So let's look at the solution. If either of the first two scenarios again occurs, the bondholders will be paid in full, and the remaining amount will be received by the stockholders. Nonetheless, if either of the last two scenarios occurs, here we have moderately disappointing sales or outright failure. The bondholders will not be paid in full, but will receive the firm's entire cash flows, leaving the stockholders with nothing. We have two zeros in here. This example is similar to bankruptcy scenarios. In this example, the relationship between the common stock and the firm is demonstrated in terms of options. First, we will show that the firm could be expressed in terms of call options because the intuition is easier, and then put option scenario will be covered. So, on an Excel spreadsheet, I created this model. So, exercise price here will be $450 million because this will trigger whether actually the stockholders will own the firm or bondholders actually will be paid in full or not, and receiving everything the firm has generated. So this will be your exercise price. I will explain this in a minute on the following slide. So start with the cash flow to the firm. Here, actually, cash flow to the firm will be the underlying asset in that scenario. And then we need to calculate the cash flow to bondholders and cash flow to stockholders. And then I will plot all these cash flows to bondholders and stockholders, and you will see their positions in terms of options. So if cash flow to the firm is less than this exercise price, $450 million, or equal to this value, cash flow to bondholders will be cash flow to the firm. They will receive everything. For example, remember, if the cash flow to the firm is less than $450 million, bondholders will receive everything. But if not, of course, they will be paid in full and then will be receiving this $450 million. And on the next slide, we will have the situation detailed for the cash flow to stockholders. So if again cash flow to the firm, remember this was the underlying asset, is equal to or less than the exercise price, cash flow to stockholders will be zero. The option will not be exercised because everything will be gone to the bondholders. But if not, if the cash flows to the firm exceeds this $450 million, cash flow to stockholders will be the difference between cash flow to the firm and the exercise price. So now we can create the plots. This is the cash flow to stockholders of Banzai company as a function of cash flow to the firm. So cash flow to the firm in the horizontal axis will be actually value of the underlying asset or value of the stock, as we have done before throughout the chapter. And in the vertical axis, we have cash flow to stockholders in dollars, and this is actually value of the call. So this is actually the plot of a call option, exercise price being $450 million. Again, we have 45% decreasing here. So the stockholders can be viewed as having a call option on the firm. If the cash flows of the firm exceed $450 million, stockholders pay $450 million in order to receive the firm's cash flows. And they will receive the difference between the total cash flows of the firm and the exercise price, or the amount to be paid to bondholders. If the cash flows of the firm are less than $450 million, the stockholders do not exercise their option. They walk away from the firm receiving nothing. And we are in here. Again, exercise price being $450 billion. So as was mentioned, first we will express the firm in terms of call options, or more precisely, the stock can be viewed as a call option on the firm. The figure on the previous slide demonstrates the cash flow to the stockholders as a function of the cash flow to the firm. The stockholders receive nothing if the firm's cash flows are less than $450 million. In that case, all of the cash flows go to the bondholders. Nonetheless, the stockholders earn $1 for every dollar that the firm receives above $450 million. Actually, this graph is the exact same call options graphs as those covered throughout this chapter. Here, the underlying asset upon which the call option is written is the firm itself, or total cash flows to the firm. That is, we can view the bondholders as owning the firm. Nevertheless, the stockholders have a call option on the firm with an exercise price of $450 million. If the firm's cash flow is above $450 million, the stockholders will choose to exercise the call and buy the firm from the bondholders for $450 million. The net cash proceeds to the stockholders are the difference between the firm's cash flow and the payment of $450 million made by the stockholders. For example, this value will be $300 million. So $750 million, the total cash flows to the firm, minus $450 million to be paid to bondholders. So this will be $300 million if the toy line is amazingly successful. And $50 million, again, total cash flows of $500 million minus amount to be paid to bondholders, $250 million, so $50 million if the toy line is moderately successful. If the value of the firm's cash flows are less than $450 million, the stockholders will not choose to exercise the option and will walk away from the firm as an irrational call option holder would do. The bondholders will then receive the firm's entire cash flow. This situation mimics a very real-world scenario. If a firm earns less than what it needs to pay its debtors, the firm is very likely to declare bankruptcy and the debtors will own the firm. However, if the cash flows of the firm exceeds its debt, the stockholders will continue to own the firm.